Hi, my name is Danny Brown. I'm the CEO of Myriad Real Estate Group, and this is going to be our August market update. We are in the midst of a big real estate shift. If you've been living under a rock, basically where we came from during the pandemic and kind of the post-pandemic world is this massive increase in home values, tons of real estate activity taking place. And ultimately, what I think has happened, just like a lot of other industries, is because of low interest rates and because of all the money that was dumped into the economy, a lot of things were pushed forward. So I think of myself as an example. My wife and I bought a house during the pandemic. We didn't need to buy a house, but rates were so low that I think it pushed us forward in our timeline. And the conversation we had was, the home that we're in, is this the home that we're going to be in for the next 15 years? The answer was no, so we decided to move, and now we're in a home that we'll be in for the next 15 years with a really awesome interest rate. And so if you think about all of the stuff that's happened during the pandemic, it all had this boom and is now starting to have to come back down to reality. And housing is no different. And so the level of demand has dropped off quite a bit, only due to affordability. I think all those people are still in the wings wanting to buy a home, but because home prices have gone up so much and now interest rates are much higher than they were a year ago, their affordability is greatly impacted on a monthly basis. Most people ultimately don't care what they're spending on a home in total. They care about what their monthly payment is. And so when the home prices have gone up, now interest rates on mortgages have gone up, their affordability is greatly impacted on a monthly basis and pushing them onto the sidelines. So if you reference back to some of my previous videos, I've been talking about how, the two largest generations in US history are hitting that prime home buying age in millennials and Gen Z. Well, they're all still there. The fundamentals of the housing market haven't really changed, where there's a lack of overall housing. So there's not enough homes that have been built for our growing population. But what has changed is that affordability. So it's pushed all those people that want to purchase a home off to the sideline because they just generally can't afford it due to these higher rates. Now, rates a year ago, even 6 months ago, were in the 3s to 4%. Well, now we're hovering in that 6% range. I think today, rates are probably in the mid 5s. And basically, the reason that the rates have gone up so much is because of the aggressiveness of what the federal government is doing to try and tame inflation. Now, last month, inflation numbers came back at 9.1%, which is like the highest rate of inflation that we've seen since the 80s, making everything way more expensive. So the Fed really wants to try and curtail that. So they're making the cost to borrow money more expensive for banks, which therefore they pass those costs on to us, the consumer. So when we want to go and borrow money, it's more expensive. So our mortgage rates are slightly higher. Now, mortgage rates are forward-looking, just like the stock market is forward-looking. So we saw this massive run-up in rates in a very short period of time, which nobody foresaw coming. I thought I was super bearish on the mortgage market earlier this year when I predicted rates would be above 4%. Never in my wildest dreams or any economist's wildest dreams did we think that we would get above 6% in a 6-month period. That has never happened in history, and so everybody missed that. And because that run-up has been so fast, nobody's had an opportunity to really catch up, and it's, again, pushed all those buyers onto the sidelines because it's greatly affected their affordability. Now, I believe that rates are going to come back down. They're forward-looking, so they have baked in all this aggressiveness that the Fed is doing. So as of this recording, the Fed hiked rates yesterday by 75 basis points. It's the second time that they've done a 75 basis point hike this year. And so rates did not change. In fact, they actually came down a little bit because the market had already baked that into the interest rates. And based on the language that Jerome Powell used in his post-meeting press conference, We suspect that the Fed will be a little bit more conservative in their rate hikes because now they're going to be very data driven rather than emotions and feelings. So they are aware that the cost of goods is coming down. They are aware that the housing market is softening. They are aware that unemployment, I believe, will start to tick up because they see hiring freezes in the tech sector. They see the articles where like Ford just announced they were going to lay off 8,000 people. So they're seeing all of this data. And I think that that will translate into lower price hikes in the future. And I do also think that we have seen peak inflation. So those mortgage rates that we're seeing today are probably higher than where they really should be. And we'll start to see that calm down as we get closer to the end of the year. So let's talk about Phoenix specifically. So right now in Greater Phoenix, we've got somewhere around 17,000 homes on the market, which is up off the low of around 3,500 homes. However, for us to be in a balanced market, normal demand, normal supply, we should still be north of probably 25,000 homes on the market. But because demand has dropped, we're in a balanced market today, which actually makes this the best market for buyers that we've seen in 8 years. The last time that Phoenix itself was in a balanced market was 2014. So the fact that we're in a balanced market today gives buyers way more power over the transaction and over sellers. So I'm in huge favor of this. Sellers have been pushing buyers around for the last longer than 2 years, but very much in the last 2 years, including builders. So these higher rates have really checked sellers and checked builders and kind of put them in their place, giving buyers a lot more power within the transaction. So of the 17,000 homes that we have available for sale in Greater Phoenix, some of the numbers that I find super interesting is only 46% of that number are owner-occupied sellers. Normal people selling their house, which comes out to like 7,000 homes. So that number hasn't drastically shot up. We are not seeing a flood of inventory come to the market. Nobody's panic selling. Nobody's going to foreclosure. In fact, last month, I think Greater Phoenix had 2 people go to foreclosure. Now, there were a lot of notice of trustee sales, and so a lot of the articles that you'll see talking about the run-up in pre-foreclosures talk about that. However, nobody actually went to foreclosure. They sold them either on the open market, they sold them to investors, or they renegotiated with their banks and didn't actually go to foreclosure. So always make sure that you're checking where the data is coming from. And really, I mean, the crazy thing with statistics is you can almost make the numbers do whatever you want to try and prove your point. So always question the motivations of who you're looking at and what you're reading. So 46% are owner-occupied, which puts 54% of all the active listings in Greater Phoenix as investors. Of that 54%, or rather of the 17,000 homes that we have listed for sale, 12% of our market is made up of Open Door and OfferPad. And those are companies that buy homes from regular people to turn around and flip them. So they want to make a profit really quickly. They'll come in, they'll put on a coat of paint, change the flooring out to put in new carpet, and then they'll list it for a higher price. Well, they were slow to react, and so they've been continuing to buy homes, and they're relisting them, and they're making up 12% of our local market. In addition to that, you've got another around 12% that are new home builders. Builders have not been listing homes for sale in the MLS for over 2 years. They were selling them like crazy to people just walking into their offices, and they didn't need to use the MLS at all. So those homes have always been there, but they were selling really fast and just never listed in our inventory. So when a quarter of the market is made up of these iBuyers and new home sales, it's not truly a flood of homes coming to the market. And the thing to think about with builders too is they are not in business, they're not a charity. They don't care that they've been underbuilding for the last 10 years. They're not planning on oversupplying the market. They build based on demand. And so they have most of the properties that they have under contract have yet to be built or are in the process of being built. And yes, they are listing homes in the MLS, but they're not building those homes until they actually sell. And anecdotally, I don't have any real evidence of this other than clients that we're currently working with. Builders are intentionally slowing down even more so on building and completing these homes because they are also aware that rates for mortgages are higher than they probably should be. And the longer they take, the lower those rates should hopefully get, because they don't want to have what is currently happening, mass cancellations. So if you think about somebody who signed a contract with a builder, 6 months ago, the interest rate they were being quoted on their mortgage was probably somewhere between 3 and 4%. Well, if they're coming up on completion today and rates are between 5.5% and 6%, that is a huge change in their payment. So now they may not be able to afford that home, and so they're backing out and canceling that contract. The number of those is finite, so we're not going to continue to see that number flood the market. So I have been predicting now for several months that while the increase in supply has gone up relatively quickly, I do believe that that is going to peak because Opendoor and OfferPad only own so many homes, and the builders only have so many under contract that are under construction right now. So that run up in listings should eventually peak or at least slow down dramatically. So what does this mean to you? Well, if you are buying a home, you have more power now than you've had probably in 8 years. There's not a lot of buyer competition because a lot of those buyers, again, are on the sideline. And so you have the ability to negotiate, and I love it. I love negotiating on behalf of buyers, getting price down. We're getting sellers to contribute towards closing costs. We are really focused on getting sellers to not only pay closing costs, but buy the mortgage rate down. So for our buyers, they are paying interest up front so that impacts your mortgage rate, brings it down, and brings down your monthly payment on your mortgage, making it way more affordable. So there are a lot of programs out there. You are not, as a buyer, locked in necessarily to a 5.5% to 6% rate. We're getting clients mortgages in the 4% range by negotiating heavily with the sellers to give some concessions. That is a winner for a seller as well, because if you imagine instead of doing a price reduction of 10, 20, 30,000, if you take that same dollar amount and buy a buyer's rate down, it's going to have a greater impact for that buyer, bringing their monthly payment down while protecting your equity and selling at a higher price. So that's protecting home values. So if you're buying, negotiate heavily with these sellers, get them to buy your mortgage rate down so that your monthly payment is more affordable. And I am a proponent of buying a home. I think it's the quickest path to wealth in our country. If you plan on owning that home for less than 2 years, I'm on the sidelines. I'm probably not buying as an investor or someone that is going to own the home for less than 2 years. If you're going to own it longer than that, and the average now is 11 to 13 years, I think whatever is happening today will not impact you. So it's a good time to buy because you have so much negotiating power, and I think homes will be worth more in the future than they are today. If you're a seller in this market, well, there is more competition, demand is down, so presentation and pricing matter more than ever before. The days of being able to put a for sale sign in your front yard and sell something that doesn't need work or to sell something that needs work is behind us, right? So your presentation matters. Your home needs to have upgrades. It needs to be cleaned. It needs to have professional photos. It needs to be staged. Curb appeal matters, so the landscaping. You actually have to do work now to make your home attractive. The good news is, while the number of listings is up, we're still below where we should be in terms of overall volume. So if your home is really nice and priced accurately, it's still going to sell, and it's still probably going to sell in less than 30 days. So you have to do a little bit of work to sell your home, but it's not the end of the world. It's just kind of more of a balanced market and what sellers should have been doing all along. All right, if you have any questions on the housing market, the state of the economy, or how we can help you buy or sell a home, definitely reach out to us. In the meantime, give us a like and subscribe, and thank you so much for tuning in.